Okay, so more generally, what we're saying is that Regulation 28 confines investors to a maximum of 75% in equity exposure. What we know from data is that generally over the long term, equities are the asset class that tend to give the best real returns or returns above inflation, and that's largely because you tend to have to take more risk in equities. Um, so ultimately, our view is very much that if you want to actually increase your alpha or outperformance over the benchmark over the long term, that you should try and take greater equity exposure in your portfolio. So hedge funds per se are not necessarily the answer to getting greater equity exposure. But what we do know is that Regulation 28 makes provision for the use of up to 10% in hedge fund strategies. What we also know is that hedge fund strategies provide a great source of stable alpha, which means they are ideal for a concept called portable alpha. Simplistically, portable alpha means that we separate out the alpha or the skill of a manager in their ability to outperform a given benchmark and transport that skill onto a different market index. So in this case, what we're saying is that hedge funds provide a great source of stable alpha or outperformance, which we can then translate onto the FTSE JSE All Share Index, for instance, and create equity-like exposure that tends to outperform the benchmark by 150 to 200 basis points over the long term. By using the Regulation 28 exposure or allowance to hedge funds, you can effectively, through a portable alpha strategy, increase your equity exposure by 10% and structure your portfolio to have up to 85% total equity exposure. I agree that pension fund investors tend to invest too conservatively. They typically invest with Regulation 28 compliant balanced funds in the industry, which would have up to a maximum exposure of 75% in equities. We believe very much in the longevity theme, which is to say that people are going to live longer and therefore have longer investment horizons. What we believe is that, with those longer investment horizons comes the opportunity to create greater compounding of returns and less risk from being exposed to more risky asset classes. So as your time horizon gets longer, your risk of losing capital from being exposed to more aggressive asset classes like equities diminishes. And we therefore believe, with investment horizons out at 20 to 25 years or more, that pension fund investors should be taking maximum exposure to aggressive asset classes as much as possible.